Welcome. Today, we're diving into the world of microfinance and its pivotal role in economic development. Microfinance refers to financial services such as small loans and savings accounts provided to individuals or small businesses who lack access to traditional banking. This concept has gained global attention for its ability to empower people, especially in developing countries. By offering financial tools to those previously excluded, microfinance helps foster entrepreneurship, reduce poverty, and stimulate local economies. In this video, we'll explore how microfinance works, its impact, and real-life examples that highlight its significance in driving sustainable economic growth. Roots of microfinance can be traced back to the 1970s, with the pioneering work of Dr. Mohammed Yunus in Bangladesh. He founded the Grameen Bank, which provided small loans to the poor without requiring collateral. This innovative approach challenged traditional banking norms and demonstrated that low-income individuals could be reliable borrowers. The success of Grameen Bank inspired similar initiatives worldwide, laying the foundation for the modern microfinance movement. Today, microfinance institutions operate in many countries, adapting their services to local needs and helping millions improve their livelihoods. Microfinance is more than just lending small amounts of money. It encompasses a range of financial services, including microloans, savings, insurance, and payment systems. These services are tailored for individuals and small businesses who are typically excluded from mainstream banking due to lack of collateral, credit history, or steady income. By providing access to these essential services, microfinance empowers people to start or expand businesses, manage risks, and build financial security. This holistic approach is crucial for fostering long-term economic development and social inclusion. Microfinance primarily targets low-income individuals, small business owners, and entrepreneurs who lack access to traditional financial services. Women in particular are significant beneficiaries as they often face greater barriers to financial inclusion. By providing them with capital and financial tools, microfinance helps them start businesses, support their families, and contribute to their communities. Additionally, microfinance institutions often focus on rural areas where banking infrastructure is limited, ensuring that even the most marginalized populations can participate in economic activities. The heart of microfinance are microloans, small short-term loans designed to meet the needs of borrowers who lack collateral or credit history. These loans can be used for various purposes, such as starting a small business, purchasing inventory, or investing in equipment. The repayment terms are often flexible, and interest rates are typically lower than those offered by informal lenders. Microloans help individuals break the cycle of poverty by enabling them to generate income and improve their standard of living. Microfinance isn't just about lending. Many microfinance institutions also offer savings accounts and microinsurance products. Savings accounts help clients build financial security, manage cash flow, and prepare for emergencies. Microinsurance protects against risks such as illness, accidents, or crop failure, which can be devastating for low-income families. By providing these services, microfinance institutions help clients manage risks and plan for the future, creating a more stable and resilient community. Microfinance plays a crucial role in empowering entrepreneurs, especially those in underserved communities. By providing access to capital, microfinance enables individuals to turn their ideas into viable businesses. This not only creates jobs but also stimulates local economies. Entrepreneurs can invest in tools, inventory, and training, which helps them grow their businesses and increase their income. The ripple effect of entrepreneurship supported by microfinance can transform entire communities, fostering innovation and self-reliance. Women are often at the center of microfinance initiatives. Many microfinance institutions prioritize lending to women because studies show that women are more likely to invest in their families and communities. Access to microfinance helps women gain financial independence, start businesses, and improve their social status. This empowerment leads to better health, education, and economic outcomes for entire families. By supporting women, microfinance contributes to gender equality and inclusive economic growth. One of the main goals of microfinance is to reduce poverty. By providing financial services to the poor, microfinance helps individuals generate income, build assets, and improve their living conditions. Studies have shown that microfinance can lead to increased household income, better access to education and healthcare, and greater economic stability. While it's not a silver bullet, microfinance is a powerful tool in the fight against poverty, especially when combined with other development initiatives. Small businesses are the backbone of many economies, especially in developing countries. Microfinance provides the capital and support needed for these businesses to start, grow, and thrive. With access to microloans, entrepreneurs can purchase inventory, hire employees, and expand their operations. This not only creates jobs but also stimulates local markets and encourages innovation. By supporting small businesses, microfinance contributes to broader economic development and community well-being. Financial inclusion means ensuring that everyone has access to useful and affordable financial services. Microfinance is a key driver of financial inclusion, as it brings banking services to those who have been left out of the traditional financial system. By breaking down barriers such as lack of collateral or credit history, microfinance institutions help people participate in economic activities, save for the future, and manage financial risks. This inclusion is essential for sustainable economic growth and social development. Microfinance institutions, or MFIs, are organizations that provide microfinance services. They come in various forms, including nonprofit organizations, cooperatives, and commercial banks. MFIs design their products to meet the unique needs of their clients, offering flexible loan terms, group lending models, and financial education. Their close relationship with local communities allows them to understand and address specific challenges, making microfinance more effective and impactful. One innovative approach used by many MFIs is the group lending model. In this system, small groups of borrowers guarantee each other's loans, reducing the risk for the lender. This model encourages peer support and accountability, as group members work together to ensure everyone repays on time. Group lending has proven effective in reaching clients who lack collateral and helps build trust and cooperation within communities. Interest rates in microfinance are often higher than those in traditional banking, but they are usually much lower than informal moneylenders. These rates reflect the higher costs of serving remote or low-income clients and the need for sustainability. MFIs strive to balance affordability for clients with the financial health of their institutions. Transparent pricing and fair lending practices are essential to ensure that microfinance remains a positive force for development. Despite its many benefits, microfinance faces several challenges. These include high operational costs, the risk of over-indebtedness among clients, and difficulties in reaching the most remote or marginalized populations. Additionally, some critics argue that microfinance alone cannot solve deep-rooted poverty or structural inequalities. Addressing these challenges requires innovation, strong regulation, and collaboration with other development initiatives to maximize impact. Technology is transforming microfinance by making services more accessible and efficient. Mobile banking, digital payments, and online platforms allow clients to access financial services without traveling long distances. These innovations reduce costs, improve transparency, and enable MFIs to reach more people. Technology also helps with data collection and credit assessment, making it easier to serve clients who lack traditional documentation. Microfinance can also support education by providing loans for school fees, uniforms, and supplies. Some MFIs offer educational loans or savings plans specifically designed to help families invest in their children's future. By making education more accessible, microfinance contributes to long-term economic development and breaks the cycle of poverty for future generations. Health expenses can be a major burden for low-income families. Microfinance institutions often offer health-related loans or microinsurance to help clients cover medical costs. Some MFIs partner with healthcare providers to offer affordable services or health education. By addressing health needs, microfinance helps families avoid financial shocks and maintain their productivity and well-being. Agriculture is a key sector in many developing economies, and microfinance plays a vital role in supporting small farmers. Microloans can be used to buy seeds, fertilizers, or equipment, while microinsurance protects against crop failure or natural disasters. By helping farmers invest in their land and manage risks, microfinance boosts agricultural productivity and food security. Microfinance institutions are integrating environmental sustainability into their operations. They offer green loans for eco-friendly businesses, renewable energy projects, or sustainable farming practices. By supporting environmentally responsible initiatives, microfinance can contribute to both economic development and environmental protection, creating a positive impact for future generations. Let's take a closer look at the Grameen Bank, one of the most famous microfinance institutions. Founded in Bangladesh, Grameen Bank has helped millions of people escape poverty by providing small loans without collateral. Its group lending model and focus on women have inspired similar initiatives worldwide. The success of Grameen Bank demonstrates the transformative power of microfinance in promoting economic and social development. EVA is a global microfinance platform that connects lenders with borrowers around the world. Through its online platform, individuals can lend as little as $25 to support entrepreneurs in developing countries. Kiva's innovative approach leverages technology to expand access to microfinance and foster global solidarity. By enabling people everywhere to participate, Kiva demonstrates how microfinance can be scaled and adapted to new contexts. Microfinance has a significant impact on local economies by stimulating entrepreneurship, creating jobs, and increasing household incomes. As small businesses grow, they generate demand for goods and services which benefits other local enterprises. This multiplier effect helps build vibrant, resilient communities and contributes to overall economic development. Beyond economic benefits, microfinance has a profound social impact. It empowers individuals, especially women, to take control of their financial futures. This empowerment leads to greater confidence, improved social status, and stronger community ties. Microfinance also encourages collective action and mutual support, fostering a sense of solidarity and shared responsibility. Many microfinance institutions offer financial literacy training alongside their financial products. These programs teach clients how to manage money, budget, save, and invest wisely. Financial education is essential for ensuring that clients use loans effectively and avoid over-indebtedness. By building financial skills, microfinance institutions help clients achieve long-term stability and success. Youth are a growing focus for microfinance institutions, as young people often face barriers to employment and financial services. Microfinance can provide young entrepreneurs with the capital and support they need to start businesses or pursue education. By investing in youth, microfinance helps build the next generation of leaders and innovators, driving long-term economic growth. Urban areas, microfinance helps address challenges such as unemployment, housing shortages, and informal economies. By providing loans and financial services to urban entrepreneurs, microfinance supports small businesses, creates jobs, and improves living conditions. Urban microfinance initiatives often focus on marginalized groups, helping them integrate into the formal economy and access better opportunities. Rural communities often face unique challenges, such as limited access to markets, infrastructure, and financial services. Microfinance institutions play a vital role in bridging these gaps by offering tailored products for rural clients. These services help farmers, artisans, and small traders invest in their businesses, improve productivity, and raise their standard of living. Rural microfinance is essential for balanced and inclusive economic development. Social enterprises are businesses that aim to solve social or environmental problems while generating profit. Microfinance supports these enterprises by providing the capital they need to launch and scale their operations. By backing social entrepreneurs, microfinance helps address issues such as unemployment, inequality, and environmental degradation, creating positive change in society. Innovation is key to the success of microfinance. Institutions are constantly developing new products, delivery methods, and technologies to better serve their clients. Examples include mobile banking, digital wallets, and flexible loan products. By embracing innovation, microfinance institutions can reach more people, reduce costs, and improve the quality of their services. Effective regulation and oversight are essential for the stability and integrity of the microfinance sector. Governments and regulatory bodies set standards for transparency, consumer protection, and financial soundness. Strong regulation helps prevent abuses, protect clients, and ensure that microfinance institutions operate in the best interests of their communities. Partnerships between microfinance institutions, governments, NGOs, and the private sector are crucial for scaling impact. These collaborations can provide additional resources, expertise, and networks, making it possible to reach more clients and address complex challenges. By working together, stakeholders can create more comprehensive and sustainable solutions for economic development. Measuring the impact of microfinance is essential for understanding its effectiveness and guiding future improvements. Institutions use various tools and indicators, such as income changes, business growth, and social outcomes, to assess their programs. Transparent reporting and regular evaluations help ensure accountability and continuous learning in the sector. Sustainability is a key concern for microfinance institutions. They must balance social goals with financial viability to continue serving clients over the long term. This involves prudent risk management, efficient operations, and responsible lending practices. Sustainable microfinance ensures that institutions can grow and adapt to changing needs while maintaining their mission. Microfinance institutions often play a vital role in crisis response, such as during natural disasters or economic downturns. They provide emergency loans, flexible repayment options, and support services to help clients recover and rebuild. By offering a safety net, microfinance helps communities withstand shocks and maintain their livelihoods. Migration, both internal and international, can create economic challenges for families left behind. Microfinance institutions offer remittance services and financial products to help migrant families manage their finances. By supporting migrants and their families, microfinance contributes to economic stability and development in both sending and receiving communities. Access to safe and affordable housing is a major challenge in many developing countries. Microfinance institutions provide housing loans and savings products to help families build or improve their homes. These services enable clients to invest in better living conditions, which in turn supports health, education, and economic productivity. Digital inclusion is becoming increasingly important in the microfinance sector. By leveraging digital tools, microfinance institutions can reach more clients, reduce costs, and improve service delivery. Digital financial services such as mobile wallets and online banking make it easier for clients to access and manage their finances, even in remote areas. Social networks play a crucial role in the success of microfinance. Group lending models, peer support, and community engagement all rely on strong social ties. These networks help clients share information, support each other, and build trust, making microfinance more effective and sustainable. Policy advocacy is an important part of the microfinance movement. Institutions and networks work to influence government policies, promote financial inclusion, and protect the rights of clients. Effective advocacy can lead to better regulations, increased funding, and greater public awareness of the benefits of microfinance. Future of microfinance is shaped by emerging trends such as digital transformation, impact investing, and greater focus on sustainability. Institutions are adopting new technologies, expanding their reach, and developing innovative products to meet changing client needs. As the sector evolves, microfinance will continue to play a vital role in promoting inclusive and sustainable economic development. Over the years, the microfinance sector has learned valuable lessons about what works and what doesn't. Successful programs combine financial services with education, support, and community engagement. Flexibility, client-centered design, and strong partnerships are key to achieving lasting impact. By learning from experience, the sector continues to improve and adapt to new challenges. While microfinance has many supporters, it also faces criticism. Some argue that high interest rates, aggressive lending practices, or lack of impact in some cases can harm clients. Others point out that microfinance alone cannot address structural poverty or inequality. Ongoing debate and research help the sector address these concerns and improve its effectiveness. Microfinance is a global movement, with institutions operating in nearly every region of the world. From Asia to Africa to Latin America, microfinance adapts to local contexts and meets the needs of diverse populations. Its global reach demonstrates the universal demand for financial inclusion and the power of microfinance to drive positive change. Conclusion: microfinance is a powerful tool for economic development. By providing financial services to those excluded from traditional banking, it empowers individuals, supports small businesses, and strengthens communities. While challenges remain, the ongoing evolution of microfinance promises even greater impact in the future. As we've seen, microfinance is not just about money, it's about opportunity, empowerment, and building a better world for all.